Hi, everyone. Thank you so much for joining us today for part two of the Princeton ESG and Sustainability Symposium, where we'll be talking about ESG and sustainability in the world of investing. Thank you very much to the Jules Rabinowitz Center for Public Policy and Finance for hosting this event. And the conversation today will be moderated by JC Swaan, who in addition to being a lecturer here in our economics department, is a partner at Cornwall Capital, an investment fund based in New York. We ask that you please save your questions until the end, where we'll have a 20-minute Q&A session. And with that being said, I'll hand it over to JC.
Great. Thanks so much, Dixon. So today we're going to talk about ESG. This is part two of our symposium. And as many of you know, the ESG revolution in investing is fascinating. It's seen by many as a tremendous force for good. But it's also a phenomenon that's just difficult to pin down and to understand well because it's so unwieldy and dynamic. It's constantly evolving. There's a vast universe of stakeholders that are all engaging in this within their own arenas, whether it's investors, companies that are recipients of investments, regulators, or even data providers, right? And so to take stock of the status of ESG and sustainable investing, we have with us today a distinguished panel of practitioners. We have Cecilia Chao, who is a managing director on the Bain Capital Double Impact team. We have Ron Jarvis, who is the chief sustainability officer at Home Depot. And we have Scott Kalb, who's the founder and director of the Responsible Asset Allocator Initiative at the New America Foundation. And he's also the chairman of the Sovereign Investor Institute at Institutional Investor. In today's panel, we will be looking at ESG from different angles. Since our panelists sit in different corners of the industry, Cecilia Chao from the angle of impact investing, Scott Kalb from the perspective of the largest asset allocators, and Ron Jarvis from the corporate perspective on the receiving end of these investments. And I should mention, Pallavi just put in the full bios in the chat. You can find the links there. So here's how we're going to structure the conversation for the session. I will kick it off by asking a few questions to each panelist, and then I'll tee up 2 or 3 topics to the group. And after that, we'll open it up to Q&A. As Dixon mentioned, you can send questions at any point in the chat, or you can raise your hand when we enter the Q&A session in the last 20 minutes or so. Okay, so let's turn to Ron Jarvis. Ron is the Chief Sustainability Officer for the Home Depot. And let me start by asking you, can you describe your role at Home Depot as Chief Sustainability Officer?
Yes, I certainly can. Thank you. It's good to talk to everyone. I think it's important for my role as a Chief Sustainability Officer that at least this group understand that I have a tremendous amount of background experience in the business itself. I've been with Home Depot 27 years. I've been a merchant, which is a buyer for almost every department inside the company, or a divisional merchandise manager or a vice president. I've ran our tool rental department. I've ran our pro sales department. So when I look at sustainability, I'm looking at it through some very deep lenses for the business. So as the Chief Sustainability Officer, I will work with all the different businesses inside of the Home Depot on a global basis. We have stores in the US, we have stores in Canada, we have stores in Mexico, we have offices, purchasing offices in India, we have 2 offices in China. And so we work all around the world as far as the global issues go for products. So for most everything that comes across the tables at Home Depot that have to do with environmental concerns or social concerns, my group also does all the overseas audits for foreign factories. So foreign migrant workers, forced labor, we handle all those issues as well. So as a chief sustainability officer, I spend a lot of time looking at the impacts, the environmental impacts. You can imagine with a company like Home Depot, we have thousands of environmental touch points from all different angles. And over the years, I've realized that we've been able to break these down into 5 categories. And those categories are carbon emissions, chemical exposure, deforestation, water use, and waste and recycling, which we're also calling circularity now. So of all the thousands of touch points, everything boils down into those 5 categories. So when we sit down and we look at issues that are either global or national, we say which categories does it fall in? Is it deforestation in the Amazon? Is it certain chemicals being used in products in China? Is it the carbon emissions that are from the products sold or manufacturing the products or the use of the products? So we break everything down into those categories and spend a lot of time looking at the industries that we deal with, and then the Home Depot's impact, not only from us as a company, but also our suppliers and our customers' use of the product. From that, we rack and stack across what the environmental impacts are for the products and industries that we have. And so as the lead officer for the company that has oversight to this, I put together strategies and practices on how we need to improve our total environmental impacts.
Great. And from the perspective of Home Depot, this focus on sustainability, and also the ESG emphasis from investors, to what extent has it affected, or how has it affected how the company is managed? Like, what are the practical implications in terms of management of the company?
And it's interesting that, ESG over the past 3 years, 4 years has brought a lot of focus and a lot of highlights into certain aspects of the business, especially the E and the S. And as we look at the social issues around DE&I, and we look at all the environmental concerns, ESG has helped that dialogue. For companies like Home Depot, we've been working on this around ESG issues for many, many years. We won the President's Award for Sustainability in 1996 from President Clinton, when most people weren't even talking about sustainability. So ESG is nothing new to us. What is new is the narrative around explaining the new processes for ESG and how you present that as a total. And I look at ESG almost as a comparison to doing the right thing and having the company's conscience. And the company's conscience is now brought forward to say, are you doing the right thing? And are you doing the right thing for the environment? Are you doing the right thing on the social side? And do you have a governance in place to make sure that the things that you're doing are the material things? I look at it and say, if you're a good ESG founded company, which most people were before the nomenclature of ESG started being used, then you know what your impacts are. All different industries and all different companies have different impacts. Your impact may be deforestation, your impact may be packaging, your impact may be carbon emissions. So you can't just get lost in the overview of ESG and say, yeah, we have a good ESG program. You've got to boil down into the impacts for each one of those industries and say, are you affecting those in a very, very positive manner?
And it's interesting that you mentioned that Home Depot got a sustainability award. In what year did you say? Did I hear in 1996?
Yes.
Wow. Because I kind of assumed that sustainability would have been a more recent focus for over the last 10 years. And that, your role, Chief Sustainability Officer, would have been a relatively new role for, maybe from 10 years ago, but it sounds like there's a long history there.
I've actually been doing this job since 2000. Now, during that time, I've had a lot of other jobs attached to me, but I've always had bolted on to what I did, leading all sustainability efforts. And our first sustainability moves were in 1992, when we were the first retailer to set standards and regulations around any environmental claim. So if you brought a product to Home Depot and you said, this product makes the sky bluer or the grass greener, or reduces carbon emissions by 40%, you had to come with a validation. And we had to have some type of certification process to show that that was accurate before we'd even let you talk about it. So no, we've been working on sustainability. That's why when we hear the ESG movement and people say, what are you doing? What's new? And we go, nothing. Nothing's new. We've already been doing this. What new is the narrative around how you talk about doing the right thing, which is ESG.
Got it. And what about the data that you need to capture? How is that evolving? Because the focus on ESG from an investor's perspective and the change in regulations, that must create a dynamic where you need to probably reassess every year the kind of data that you need to capture. How do you think about that?
Well, we actually I started a program in 2007 called Eco Options, where we started pulling products and saying, okay, what are these products' impacts on the environment? What is deforestation impact? How many gallons of water do we customers use to our products? How many can we save by changing to Water Sense or Energy Star? So those reports we started pulling in 2007. We started doing our complete carbon analysis in 2009. So, we've got 12, 13 years worth of data backed into what we've been pulling that we're able to look at and say, this is what we have. What we're able to do now is package under ESG and say, here's a portfolio of carbon emissions, of environmental impact of products, of packaging, of plastic reduction, of any type of styrofoam or EPS or PVC reduction that we have, so we can present it in a way that investors can look. And what I would definitely suggest investors do, understand the companies you're investing in and know their impacts. You're going to hear me say that a lot. You have to know your impacts. So the investors need to be able to look at a company and say, okay, for this company, I'm really not concerned about carbon emissions, or for this company, I'm not concerned about plastic packaging, but for this other company, I really am. So when you have ESG, you have to be able to quickly get to that second tier of what the issues are and understand where they are. I do know, there's a big push for consolidation, so investors and other folks can look at it and go, give me some type of scorecard that I can look across the board and I know who the good guys and the bad guys are just by glancing at a scorecard. Now, that's going to be hard to do because you have to have the objective points to go into that of what's important and what's not important. And some of that can be subjective as to how they put in the objective issues. So yeah, we pull a lot of data and we have for quite a while.
Great. And one more question. There's so many different categories of action within the domain of sustainability, and from your carbon footprint, sourcing of wood, level of chemicals. How do you go about setting priorities? I mean, you mentioned that you have 5 big areas of emphasis, but how do these evolve over time? Like you must need to pick your battles, presumably.
Well, you do. We have 3 million items. We have 50,000 suppliers. So you look at that and go, okay, how do you narrow that down? And we don't have 5 main buckets. We have 5 buckets. So everything that we work on falls into one of those 5 buckets. And when you think of carbon emissions, we have climate change, we have global warming, we have methane, we have NOx. All of that comes down to carbon emissions. So everything and most every bit of that is a combustible engine, whether it's a combustible engine that's running a power plant that's giving us the power to plug in an Energy Star refrigerator, or whether it's a combustible engine that's running a leaf blower or a lawnmower, it's the combustible engine. So we know that a major focus has to be on the combustible engine. How do we work with our suppliers and how do we work with our customers to where they say, let's first get a greener grid. Let's continue to move to a green grid, but then let's have something that we plug in instead of having to crank up that has carbon emissions coming out of it. So we look at those as priorities, and then I look at our core business and I say, when people think of Home Depot, what do they think of? Well, they think of carpet, they think of paint, they think of lumber. So those issues, we need to be deep in those. We need to understand what those environmental impacts are. We need to know if there's something going to happen downstream with those that's going to be a deterrent to our investors, that's going to hurt the sales or hurt the stock price. And so we rack and stack it based on, number one, what are the biggest environmental impacts of the products that we carry? And then how core are we in each one of those?
Great. All right. Well, thanks for this, Ron. Let me move over to Scott. So Scott Kalb is the founder and director of the Responsible Asset Allocator Initiative, a New American Foundation. Scott, it'd be great if you could describe, to start with, what is the Responsible Asset Allocator Initiative?
Sure. And thank you all very much for inviting me to be here today. It's great to be with you. So the Responsible Asset Allocator Initiative, or the RAAI, as we call it, at New America, is focused on mobilizing capital from the world's largest institutions, investing institutions, sovereign wealth funds and public pension funds, to solve the world's greatest challenges. In partnership with the Fletcher School at Tufts University, the RAAI publishes the RAAI Index and Leaders List report, and I posted it in the chat. You can find a link to it if you're interested. The report rates and ranks the world's largest 250 asset allocators with total assets under management of about $26 trillion. And it identifies the 50 best performers that set a global standard for leadership in responsible investing. All of the data and the charts are downloadable, so you can follow along. See, it's freely available. The purpose of the RAI rating system is to, one, inspire a race to the top, two, create a baseline of current activity so we can compare progress, three, it's also to hold asset allocators accountable for their responsible investing practices. We hold companies accountable, but the investors should also be held accountable. Four, we want to mobilize capital toward responsible investing goals such as renewable energy or affordable housing or healthcare, education, and so on. We also provide programming and support. We also do advocacy work. Our core belief is that global asset allocators have the capacity to make a significant difference in capital markets. And by working together, the RAI seeks to advance systemic change for a more sustainable world. So that's the RAI. And as you know, before that, I worked as the CIO and deputy CEO of the Korean Sovereign Wealth Fund, the Korea Investment Corporation, which is a $200 billion fund investor. And it was in that role that I got to know many of the other asset allocators around the world. And that led me to set up this initiative and also the Sovereign Investor Institute, which I chair.
Great. And the constituency that you target, so it's essentially the largest global allocators, right?
Right. I mean, I think the value of this group is that it's got a very high density of AUM, to assets under management, to number of institutions. So if I have 250 institutions that have over $26 trillion, if I can get a 1% penetration on a particular issue, that's $250 billion that could be flowing into some particular, sustainable theme or responsible theme. And so that can really, I think, it really can impact. What you find in the marketplace is that these are very long-term shareholders, and they're very large, and where they move, capital markets tend to follow. Certainly external asset managers will follow, and companies also are interested in what they have to say because they're large and long-term in their managing intergenerational capital, basically, in their holdings.
And one question that comes to mind, now that we're several years into the ESG phenomenon or revolution, what do you think are the key issues that these large asset allocators are grappling with today? Because presumably what they were focused on 2 years ago is different from what they focused on 4 years ago. And like, what is today the key issues that you're really discussing around the table?
Well, I think the first thing to understand is that actually investors have increasingly adopted ESG metrics. That wasn't always the case 10 or 20 years ago, even as Ron was busy and trying to make sure that the company he works with is the Home Depot is acting responsibly. It wasn't necessarily adopted by the investment community wholeheartedly. But what we have found is that the take-up has really accelerated. We're a little bit behind here in the US, but in other countries, they're, I think, much further along. It's this idea that actually you need to adopt ESG metrics in order to manage longer term type risks in your portfolio that are not necessarily captured by traditional financial metrics. And that fiduciaries recognize that they need these tools actually to do a better job for their savers. So that's the first thing I would say. And the second thing about ESG is that it's, ESG itself is it's a tool, as I said, for managing these types of long risks, but it's a long-term risks. But you should think about ESG as sort of like the Hippocratic Oath for investors. I think Ron also mentioned a little bit about this, which is, do no harm. When you invest, it's the idea that you don't want to contribute to, necessarily to systemic risks, especially that could be detrimental to your stakeholders or your savers as a fiduciary. So what that means, there's also been an increasing understanding that, hey, you don't need to invest in companies that are polluting the environment or engaging in slave labor or using corrupt business practices or something in order to make the returns that you need to meet the obligations for your savers. So if you don't need, it's a big world out there. There's a lot to invest in. If you don't need to invest in those companies, then you don't necessarily want to. And the idea is that you should, be a little proactive in thinking about that. So in terms of, sorry, it's a little roundabout. In terms of the actual issues that everybody's focused on, clearly there's a huge focus on climate change. I'd say that's the number one priority for most of the institutions. And the other thing you have to understand is that you're thinking about these risks in two dimensions. One is from a portfolio level. You want to make sure that the companies that you're investing in understand these risks, have acknowledged them, and are taking steps to protect themselves and their business. So that's your portfolio level. And you also want to make sure that the companies you're investing in appreciate the sort of system-wide risks that exist, and that they're taking steps to make sure that they're not sort of offloading those problems from their balance sheet to the system. So that's how investors want to think about it. And there's some risks like climate change. This is a systemic risk, right? It's a system-wide. You can't diversify. It's not an idiosyncratic risk that you can diversify, let's say through using modern portfolio theory techniques. It's a system-wide risk. It affects everything. And so you need to make sure that you're not, you're trying to mitigate those risks in the portfolio for your savers, but also on a system-wide basis. I hope that helps. Other things that guys are very interested in, they're looking also at things like diversity, equity, and inclusion. Racial justice, gender equality are very important issues. They're looking at also at income inequality issues. They're looking at supply chains. They're looking, it's a variety of different issues. Some are prioritizing water or development, education. But I would say the top two are climate change and then DEI.
Okay, great. And correct me if I'm wrong, but it seems to me that the largest allocators that you're focused on, the sovereign wealth funds, the pension funds, the endowments, they seem to have been at the forefront of the ESG process for a number of years. And I'm curious if you have a view as to why they've been at the edge of the wave rather than, like the hedge funds, for instance, or like the, smaller funds. It seems like they've really moved the dial on this issue.
Well, I think part of it is being driven by stakeholders. In other words, the saver. Remember, these asset allocators in the end, they're still managing. I mean, they have they're managing money on behalf of their savers, the peoples of their states, and they have an important mission. They've got to make sure that they achieve an appropriate risk-adjusted return to meet the long-term health care or savings targets or endowments or retirement benefits of the peoples of their states. And they've sort of begun to understand that they can't simply use, I mean, that's how I was trained years ago, was really on just using financial metrics. And they've recognized they can't simply just use those financial metrics if they're going to do the job properly. And then they also, so that's an internal decision. And then their stakeholders are also are pushing because they want to make sure that that their money is being invested properly. They want their institutions to actually issue a statement. What is the policy on responsible investing? What is the view? Is there a view? And it's coming up more and more. So I think there's a bottom-up push and also top-down in terms of being able to get the work done. We're also just seeing that increasingly government and regulatory action is also moving in this direction, I think, in response. So investors need, look, one of the big issues is greenwashing. So investors want to know if the companies that they're investing in are doing what they said they would do. Mm-hmm. So, so Ron has been working hard for 20 years to not only to let people know what they're doing, but to make sure they're actually doing it. So one is that investors want to know, companies make a statement, what are you going to do, and make sure they're doing it. The other thing they want to do is they want to make sure that the actions being taken by the invested companies are aligned with their own belief system or the belief system of their savers. Because again, the asset allocators, it's not their money, it's their savers' money, and the savers have some particular interests.
Great. All right. Well, thanks so much, Scott. I appreciate your answers here. And let me move to Cecilia Chao. So Cecilia Chao is Managing Director of the Bain Capital Double Impact team. So you have a very different perspective here because not only you're on the investment side, but you're an impact investor, meaning that you have two goals, financial returns and social impact. And so can you describe your investment approach? What are your formal objectives? And then secondly, I mean, that's always the question that is fascinating is, how do you evaluate and monitor the social impact piece?
Thank you also for having me. I'm excited to participate in this very exciting discussion. Our objective is to scale these mission-driven companies by using our proven value-added approach to deliver, as you commented on, both the competitive financial returns and the measurable social and environmental impact. And so in order to do that, we focus on three key themes where we believe we can create long-term value and meaningful impact at scale. So those three areas or verticals are health and wellness, where we improve health outcomes for underserved populations, so elderly population as an example, by really providing access to that quality, affordable care and promoting healthier lives. Our second vertical is education and workforce development. So we're reducing skills and achievement gaps, and particularly in underserved communities, and improving economic mobility. And our third vertical is sustainability. So here we're focused, to the number one issue that Scott highlighted, reducing environmental impact and GHG emissions, to address and mitigate climate change. So, with businesses focused on more sustainable products, services, business operations. I think to your second question on how we evaluate and monitor impact, we have a very rigorous impact measurement and management process that we actually had independently verified by Bluemark, which is one of the leading providers of impact verification. And we were very excited to, score advanced across all principles on the operating principles for impact management. And I think that actually helped, lead us to being awarded the Impact Investor of the Year by Private Equity International. And so, what does our approach include? So specifically, we embed impact practices from sourcing all the way through to exit. So, some of the things we have in that, for example, sourcing and diligence, we use IMP's impact screening template to evaluate, who, what, contribution, risk, things like that. We obviously have ESG due diligence in the diligence process. We also, included in all of our investment committees have an impact theory of change. Like, how are we going to address, our impact? Why does this company address and provide solutions that will help, that we believe can help, scale our impact? Post-close, we have, measurement and management. I think, again, to the, Scott's point on greenwashing, we want to make sure that we're holding companies accountable, including ourselves. And so all of our companies conduct a B impact assessment. So the B impact assessment is what all B Corps take. Not all of our companies will become a B Corp, but everyone takes this B impact assessment because we find it's a transparent process to assess across all stakeholder groups of environment, community, workers, et cetera. And so we drive improvement on the B impact assessment each year. So one of the key things we also do is every portfolio company has management incentives tied to improving impact, one of the metrics being the B impact assessment. So for example, as part of our budgeting process, we don't just budget, financial improvement, we also budget impact improvement, predominantly three key components: diversity, equity, inclusion, the B impact assessment improvement, which is essentially like how a business is performing, and then there's more bespoke impact metrics, which is very specific to what the company is trying, the solution that the company is trying to provide. And then even at exit, we, have governance mechanisms to really sustain our impact all the way through the sale process. So for example, as part of the RFP process, when we solicit bids, we put in our template that we request bidders to tell us how they're going to maintain impact, post our exit. We also put in our purchase and sale agreements what we call impact covenants, essentially covenants that protect that you will maintain our impact council, that you will continue to, for example, preserve some of the impact processes that we've put in place, like tying management, compensation to impact. And so, and lastly, I think a key part is we try to verify, the potential acquirer's impact track record, where it's available. So I think that those are just a few of the ways that we really try to make sure that we're holding ourselves and our companies accountable through, through the entire process from sourcing through to exit.
Wow. And I wonder, how does that translate into what you communicate to your investors? Because presumably, so you'll have, I don't know, like quarterly reports or something like that to your investors. Presumably the financial piece is simple, like well, I guess your companies are private, but you need to report, how they're doing financially. The social impact piece must be much more sophisticated. And is there, so you report a bunch of social impact metrics on what is it, a quarterly basis, or how does it work?
Yep. So we do report. We in fact create an annual year in review so that we make public to everybody. So our impact report that shares many of our, each of our companies has, as I mentioned, so this cross portfolio where we use the B impact assessment. So we post their scores and our average improvement, and we post their key bespoke impact metrics. So we share that publicly. The board will review the impact metrics on a quarterly basis, just like we review financials. But essentially, we report on those metrics publicly in our impact review annually.
Interesting. And I'm curious, when you meet with your investors who are already invested in the fund and they just want an update, do they tend to kind of focus on the understanding the financial returns or focus on understanding the social impact? Like, where is the focus of the conversation?
I think it's actually very much both, but I would have said fundraising has evolved for us. Like I would have said Fund 1 for us was very much focused on, could we deliver competitive financial returns? Wouldn't we necessarily be concessionary? Because in addition to, doing financial diligence and business diligence, now we're going to add, sort of these impact diligence. So wouldn't it necessarily be concessionary? So I would have said Fund 1, we spent a lot of time, proving that we believe we could be competitive. And now actually, the reverse is true. They see the, top quartile returns that they feel, that's no longer the focus on fundraising. It is how are we going to measure and, demonstrate the, social and environmental impact. So, I would say that there's been a shift, at least, for example, in fundraising, on where the focus is on where the investors are interested in probing.
And actually, that leads to the question of, impact investment funds tend to be on a spectrum of those that are looking for a minimum financial return and they're trying to maximize social impact, to, on the other end of the spectrum, those who want to have a minimum threshold of social impact, but they really want to maximize financial returns. Where are you on that spectrum? How are you positioned?
Honestly, I would say that both are important for us. And honestly, we want to drive top performance across both. And I honestly think that it's possible. Like, I don't think that there's necessarily a trade-off. I think, as I mentioned earlier, we want to create long-term value and meaningful impact at scale. And essentially, to do that, we have to balance both the financial and the impact objectives based on the goals and the verticals we have. Many times, the two are intrinsically linked, since we're fundamentally investing behind themes that where if the business thrives, so does our impact. But that said, there can be times where goals might be at odds, but ultimately, I think we try to balance those outcomes, on the best long-term needs for the company. I think one of the advantages we have is that we are private. And so we are really focused on, I think if we do the right thing in the long term, both the financial and the impact, outcomes will be maximized.
Right. And these are what, 10-year funds? Is that the structure?
Yeah, and yes. And then we try to invest over more like a 5-year horizon.
Okay. And it's you said your second fund?
Yeah, we're on our second fund, correct.
Okay, great. Well, thanks so much for sharing this. Great. Well, let me turn to broader questions to the group, and of course, for all the participants, please jump in for now in the chat if you have any questions. I'll just ask maybe a couple questions to the group, and then we can move to a discussion with the audience. But let me, ask the perennial question when it comes to ESG, which is, one of the enormous challenges of ESG, of course, has been the definition and standardization of ESG metrics. And there's just been numerous standards that have been competing to become the norm. There are so many acronyms floating around. Some of that, some people refer to it as the alphabet soup. And at the same time, it seems like we're seeing some progress, right? Where, we saw the formation of the ISSB, the International Sustainability Standards Board, following COP26 climate conference in Glasgow. And so the question is, now that, well, and let me mention, in addition to, one of the challenges is that we're not only seeing multiple standards, but it's not uncommon to see ESG rating divergence for a given company between different ESG data providers. And so the question in my mind is, what is your perspective on where we stand in that? I mean, enormously difficult process. How much more needs to be done? I'd be curious to hear, any of the panelists' thoughts on this.
I'd say, I think we're early days. I think, as you may know, the ISSB was itself a merger between the Climate Disclosure Standards Board and the Values Reporting Foundation. The Values Reporting Foundation was itself a merger, a combination between the SASB standards and the Integrated Reporting Framework. And so, consolidation, is progress, but at the same time, new standards are emerging. So you have the Data Convergence Project led by ILPA. You've got Novata, which is led by another consortium, including Ford Foundation, Omidyar, S&P Global, et cetera. And then you've got Invest Europe, which also announced that it's going to launch its own framework as well. And so I think the market knows we have to simplify this very complex and frankly competing landscape, of all these reporting standards, but I think we're still early days. I think, still early days from achieving any sort of market consensus on a standard.
Thanks.
I think that this issue is a little bit of a red herring. I think that there's been enormous progress made over the last, probably more progress in the last 5 years than we saw in the previous 30. There's I think Cecilia mentioned a few of them, but the Sustainability Accounting Standard Board, which set up a heat map by industry to try and figure out what's material to what industry. You have the TCFD, the Task Force for Climate Change Related Disclosures, which has been a global effort to try and come up with some reporting standards, and which is being adopted widely, I think, in the US and Europe. You've got the IFRS, the international, which is basically runs the global standard for accounting, which is now teamed up with the Sustainability Accounting Standards Board and the GRI, the Global Reporting Initiative, which works with companies to try and come up with accounting standards, global sort of accounting standards that can be included. So yes, you do have a lot of initiatives, you do have a lot of things. Is there one set standard? No, but we've got a lot more information, we've got a lot more data, and I think that everybody's sort of acknowledging you got to move forward, and you can't let the perfect be the enemy of the good. You can't, if you're going to sit there and wait for the perfect standard, you're never going to get anywhere, I think. So I think the idea is people more and more are using these so-called imperfect standards, and then improving them as we go, as those standards themselves get improved. The one thing I would say that we need is we do need people to use widely accepted standards that are out there instead of making up proprietary standards, because then that becomes very difficult. So for example, in real estate, there's the Global Real Estate Sustainability Board, or there's LEEDs, which are used very widely. And you want to make sure that your asset manager or the companies are following along those standards, because then you can aggregate the data. Everybody's sort of on the same page. Whereas if you're working with somebody that's making their own standards, it's hard to aggregate your data. So even though they may not be perfect, there's enough out there, I think, that you can utilize, you can adopt some of these standards and utilize them effectively.
We look at it as, it's kind of like, over the years, I've tried to come up with a supplier scorecard. People say, why don't you have a supplier scorecard? Put all your suppliers in a big bucket and score them on A through Z or F, whatever. Until you get a baseline by industry to where you say, this is the optimal performance for manufacturing or producing by industry, it's hard to compare DuPont with Bonnie Organic Plants in Alabama and send them both a spreadsheet or send them both a scorecard without some definitions by their industry to say we have a rating. That's what I see with the alphabet soup today. It's okay, what's more important? Is it carbon emissions? Is it DE&I? You have, what are you trying to gauge? And then you get back a convoluted result that you don't have definitions by industry or by activity as what is the best of the best that you can compare it to. Now, I'm glad that we have something. I'm glad we're moving in that direction. We need to have some type of process that investors can look across the board and say, tell me something that weeds out the bad guys, and we can move forward with that. But until we get to that, I think I'm with Cecilia, we're in the early stages. But for me, I look at it and say, it's going to be really hard to have one size fits all when it comes to the different types of industries and the different types of markets that we deal in. But, hopefully we'll get there.
Right. And one way to nudge the industry towards convergence is through regulation, of course, and it's more than nudging; it's imposing some sort of convergence. I'd be curious to hear anyone's thoughts on the new SEC proposal that finally came out right on Monday. It's been long awaited. The SEC came out with climate-related disclosures for investors, and it's still proposal stage. But in particular, the proposal requires all companies to disclose direct emissions from operations, so what they refer to as Scope 1, indirect emissions from operations, which is Scope 2, but also it would require larger US companies to disclose some of their so-called Scope 3 emissions, which are those that are generated by other firms in their supply chain or their customers using their products. I'm curious. I mean, you're sitting in very different corners of that universe. Any reaction to that SEC proposal that just came out?
I'm sure we all have thoughts about it. I certainly do. Maybe, I don't know, maybe Cecilia, you want to go first?
Happy to. I mean, I think we, being an impact fund, I think we think it's an important first step. I think, as Scott, you indicated earlier, frankly, the US is a bit behind. Many other countries have already mandated climate disclosures, and in line with the TCFD. So I think it's an important first step, and especially starting with large cap companies. We are focused more on the middle market and lower middle market, which I think, ensuring that we don't overburden some companies with excessive reporting, because I don't want to lose the plot on impact investing, which is we're really trying to focus on outcomes, which is a point Rod made earlier, like what are we trying to achieve? So I don't want to overburden on reporting, particularly as you put in the chat, we're focused on materiality. So we want to make sure we're reporting on things that are material for our companies. But, I think climate is a very important aspect.
And Cecilia, question, is the SEC proposal largely on listed companies? And if that's the case, how closely do you feel you need to monitor what these regulations are, given that you're really in the private space?
Yeah, so it's for public companies and focused on large companies with sort of, I think, some exceptions. If you're smaller, for example, Scope 3, I think was called out specifically. We do monitor, I think, both because we want to see, regardless of where it sits, what best practice is. So we want to be the tip of the spear. So certainly, if there are new standards coming out, we want to make sure we're doing that and more. And so we're very much observing what's going on in the marketplace. But in addition, I think fundamentally, we also hope some of our companies will go public. So we have one company already that has had an IPO, so it is still relevant even from a regulatory perspective.
Right.
Scott?
Any other thoughts or comments?
Yeah, look, I for me, from my point of view, this is a long time coming. It's been very the SEC has tread very carefully. They first started to broach this in reporting requirements in 2010. But we've talked about this, but for those who are not aware, the US SEC takes a principles-based reporting approach, or has, which means that they've told most companies in the past, if it's material, you should disclose it. And that also pertained to climate-related information. They wanted to sort of leave it there and see what happened. So it's been over 10 years, and the feedback that's come back over time from investors is that they're not getting enough information in order to make informed decisions about how they invest. So investors have been saying we need more information, and even some companies, I'm sure Ron can comment on it, have been confused because they've been getting inundated with requests from information from their investors, and they're not sure what they should report and what they shouldn't. So this is, I think, a welcome addition. It marks a departure because they're being more explicit about what they want to see companies report. Scope 1 and scope 2, I think, are not that controversial. Many companies have already been doing this. If they haven't, then they ought to get started. Also, many companies already, or have been for years, compensating their officers based on some ESG metrics, including climate or diversity. And, because they know these things are important. And if they're compensating their people on such, maybe it's 10 or 20% of compensation, then it should be disclosed. And finally, when it comes to scope 3 is tricky, but it's necessary. There are some businesses where all of the climate change related impacts are in scope 3. For example, utility. It doesn't use a lot of, it may not emit a lot of, carbon emissions or have big problems in scope 1 and scope 2. But how that product gets used by their customers, or how they source it from their supply chains, is enormously impactful. So I think that the SEC is being very careful about this. They put safe harbor in place, even for large companies. They made it very clear they want companies to report, but they're protected against liability on scope 3 reporting. So that's good. And they're going to try and give companies time to sort it out. I would say to JC, I would say to you that this would be a great student project, frankly. Maybe you could get some of your students or graduate students to work. The SEC published a 510-page proposal with 1,067 footnotes and 201 questions they want to have answered, specifically on this proposed rule change for climate change related disclosures. And it would be great to put together a group that's interested in responding to those questions in the rule change, do some work and send back an opinion. I mean, we write comments. I'm sure Cecilia does. I bet you do too, Ron. So we've responded. This one's a monster in terms of getting your arms around it. But it would be great to see, that would be a great initiative. No better way to really understand the issue than to try to dig in and make a comment.
Yeah, great. Well, thanks.
And as for us, as we look at it, as someone that would have to implement this, we are all for transparency. We think that the world, that investors, that everyone needs to know that the company that they pass, or the corporate office they see downtown, what their impacts are as far as carbon emissions go. Now, scope 1 is your own carbon emissions. I think we should track those. I have no problem with us announcing those and people reporting out on those. I think they need to. Scope 2 is going to be reported as the utilities scope 1, because they're the ones manufacturing the energy that you're buying from the grid. So that's going to be reported in their scope 1. Every part of scope 3 is going to be reported in someone else's scope 1. So as we look at the integrity of the numbers inside of getting to scope 3, if I look at scope 3 and say, okay, I need to track a factory in Vietnam that's manufacturing products, and I need to come up with a emissions number from that factory that's getting it from a grid or maybe getting it from their own energy source. And I need to know that I have integrity in those numbers enough to report to the SEC. No one's going to have those for a while. And I think that we're in jeopardy of the scope 3 becoming so elusive as far as being able to get to the exact numbers. Now, we do scope 3 monitoring today. We do modeling. I pull scope 3 numbers for manufacturing. I pull it for use of product sold. I pull it for employee commute. But then when I look at those, I go, okay, this is directionally correct. So scope 1, scope 2, I feel really good about those. So I think that as the SEC looks at it, they should start with a getting to first base, which would be everyone reporting on scope 1.
Well, thanks. And obviously this could be the topic or the subject of a much longer conversation. But let me move on to student questions. So now for the hard questions. Let's see. So any student who's interested in asking a question, you can raise your hand or you can send something to the chat. I see some in the chat. Let me start with, so there's a question for Cecilia. Can you expand on including covenants with buyers regarding management of portfolio companies post-sale? And that apparently that's something that Bain Capital Double Impact has done. Have you already successfully negotiated sales with such covenants? How much pushback or resistance has the marketplace offered on this approach? This is a question from JB.
Yep. So, as we even highlighted in what we've posted, we did use this, for example, in our recent exit with Penn Foster. And so we have actually used this in our exit. I would say that we didn't get a lot of pushback. I think the reality is the world is moving more to conscious capitalism, and it is the right thing to do, that we put in practices, I think much like Ron has done at Home Depot, that is both sort of additive to the business and commercial and long-term health of the business. And so, I would say that we really didn't get a lot of pushback. We, sold it also to a impact-oriented fund focused on workers. And so, really we're able to successfully ensure that that was going to happen, and fundamentally through the entire process, it was important to us. So from the RFP process all the way through to close and negotiating contracts, it was clearly stated that was important to us. And I think it helps to ensure that impact will last, not just during our ownership, but through to the next at least.
All right, well, thanks for this. Question from Richard Yang. The question is, there's some literature on how certain ESG standardized measures are hindering further progress, and I think by focusing on a minimum threshold, right? So Richard mentions the example of companies which are pushing for 1 or 2 females or women to be part of the board, but then not much more than that. Are you or is anyone at all skeptical about industry-wide metrics that might stifle further progress?
So I'll take a crack at that one if you like. That's true that there can be an effort perhaps to sort of be focusing narrowly on a particular smaller goal than on the larger problem. Most, institutions, the asset owners I talk to, they always tell me that with climate, they're not investing, they're not sort of adopting climate change metrics to fix climate change in their portfolios. They want to try and also make sure that they're fixing climate change system-wide. But anyway, what I would say on this is that there's also a lot of evidence out there showing that countries and jurisdictions that have a higher disclosure regulatory regime tend to have better company performance and investor performance on sort of responsible investing and ESG metrics. So the idea there is that disclosure and regulations can make a difference, and that even if you have low targets, that's an issue of setting your targets. So maybe you set your targets and improve them. But we see clearly that one benefit is if you actually have a requirement for disclosure on a particular issue, is that it focuses attention on it. And then either investors and companies too will, if that is an issue, they're going to focus a bit more on that performance, on that metric. And so I think you can drive better outcomes through establishing ESG metrics and disclosures. And I think that there's a lot of literature out there that points to that conclusion.
Right. One question, and we're almost out of time here. 1:20 is our and what. So a couple of you mentioned greenwashing. So the process of falsely signaling that you're environmentally sound for marketing purposes without the substance to back it. Do you have thoughts on what's the solution to this? Because that's been a growing problem as the popularity of ESG has surged. Any thoughts on how we tackle greenwashing?
We've looked at greenwashing over the years for many different cases, including product claims. My take is that you have to know your impact, and you have to focus on your impact, and don't try to distract the issue by looking at a part of the ESG that is minimal and non-core to your business and making big statements and big movements there and ignoring your biggest impacts. So it's really understanding your impacts and putting your focus on what your impacts are, not what's easy to do.
Yeah, materiality is key. I 100% agree with Ron on that one. There's academic evidence showing that companies that perform well on ESG metrics that are not material to their business have there's no particular performance correlation at all. In fact, some of them tend to underperform. So materiality has got to be key. But on greenwashing, part of it is, as I said before, you want to make sure the companies are doing what they say they're going to do, and that they're not doing something that conflicts with what they said they would do. And that's very important. And part of that's going to be from, again, from regulation and disclosure and from enforcement. But I think that you just want to make sure that you want to reward companies that are making public statements about good behaviors and then following up. And no company is going to be happy about somebody else in their industry who's saying doing all these good things while actually they're not. That doesn't help anybody. So I think we're moving in that direction, and I think that's a positive.
Great. And we have 1 minute left, so I'm going to sneak in a final question, and that's for Cecilia. My question is actually tangential in some ways, but I'm going to ask it on behalf of many of the students, I think, who are probably too shy to ask it, which is so many students want to work in impact investment. And there are so few jobs in impact investment. Do you have any advice, like for the path from college to impact investment?
I guess I would say that the field of impact investing has grown substantially. When we first entered, we were the first beyond venture to get in, but now, of course, you've got many cross-platform funds that are in, plus you've got global funds. And so first, actually, I think the space of impact investing has expanded exponentially. Second, there's a lot of ways to have impacts. I think as Ron shown, not just like investing in impact, but like companies themselves with the sustainability officers and initiatives even more broadly, are driving impact. So I would just say that there are many paths to having real and scalable impact.
Great. And thanks. And Ron, it sounds like you might advocate for someone who wants to work in sustainability at a firm to actually go through the business units and the business of the firm.
Highly recommend.
Okay.
I just think that this is being normalized. And what I'd say is that 5 years from now, we won't be talking about this as separate initiatives,
right,
but that it's going to just be completely integrated into, as it should be, into what we do. And so there should be positions everywhere related to this field.
Great. Well, Scott, Ron, Cecilia, thanks so much for spending the time with us today and for sharing all these insights. We very much appreciate it. Thank you.
Thank you, JC, for facilitating.